Money might not work the way you think, and today you'll see something shocking. Most people use money every day, but almost no one knows where it truly comes from. If you think money is printed first and then given to you, that's not the full story. Today, we uncover how banks, governments, and your own wallet create the money you use. Let me warn you, once you understand this, you won't see money the same way again.
In a bustling city, the modern economy.
Here's a wild truth. Most money doesn't exist as cash at all.
Truly impact our financial lives.
In fact, more than 90% of money is just numbers inside computers. And the craziest part? New money is created almost out of thin air. Banks can create money when they give loans, even without having that money first. And yes, the government also creates money, but in a way you might not expect. So the money in your wallet might be the result of decisions you never saw. Let's start with a simple question. What is money, really? Money is a story we all agree to believe, a shared imagination we treat as real value. If everyone stopped believing in this story, money would lose its power instantly. But because everyone believes, money works, sometimes too well. Here's the twist. The money you see is only a tiny piece of the real money system. Most money is created not by printing, but by typing. The $20 bill in your wallet is real, but that $40,000 loan was created almost instantly. And soon you'll see exactly how that magic works behind the scenes. But first, understand this. Every loan creates new money, not borrowed, created. This idea shocks people, but it's the core of modern banking. Even stranger, your deposits help create money for others, automatically. So the money in the world keeps multiplying, faster than you think. And while this sounds exciting, it also comes with hidden risks. Before we dive deeper, let me show you the exact moment new money appears. Let's see how new money appears inside a modern bank. Imagine you apply for a $50,000 loan for something simple, like fixing your car. If the bank approves your loan, something important happens instantly. The bank doesn't move money from someone else's account to yours. Instead, the bank simply creates a new deposit in your name. This new deposit is new money created at the moment of lending.
And just like that,
No printing, no moving cash, just accounting entries. This process is accepted and regulated in every modern economy. Your loan becomes the bank's asset, and your deposit becomes its liability. The money you spend from that deposit now enters the economy. The mechanic who receives your payment gets a new deposit too, created by the system. This is how bank-created money spreads throughout the economy.
banks don't lend the cash.
And unlike popular belief, banks aren't limited by the amount of deposits they hold.
It's in the vault.
What limits them is risk, regulation, and capital requirements, not deposits. Banks must ensure they can handle losses if loans fail. So they lend carefully, because bad loans can bring huge losses. But as long as loans are profitable, banks continue creating new money. Now think about this. Your deposit didn't come from someone else's savings. It was created the moment the bank typed it into your account. This is why over 90% of all money is created by commercial banks, not cash printing. When you repay your loan, the created money disappears from the system. That's right, bank-created money is temporary.
But what happens when the principal disappears?
The only thing that stays is the interest you pay. Money is born when loans are issued and dies when loans are repaid. This cycle constantly expands and contracts the money supply. If banks lend a lot, money supply grows.
The money supply is contracted.
If lending slows, money supply tightens, affecting spending and prices. This is why credit drives the modern economy more than cash ever could.
For your financial future. Banks influence housing prices.
Through lending, banks shape housing prices, business growth, and even jobs.
Credit powers the modern
Every mortgage, car loan, and business loan adds money into circulation.
creating opportunities for all.
In the fractional reserve system,
But keep in mind, more money also means more debt in the system.
the modern economy is a balancing act.
Debt and money grow together. They're two sides of the same coin.
The inevitable reality of debt.
That's how banks create most of the money you use every day. And next, you'll see how the government and central bank create money too. Because their method is completely different and just as surprising. Let's look at how the government and the central bank create money. Surprisingly, printing cash is only a tiny part of money creation. Most new money comes from digital actions, not physical printing. When the government needs money, it usually issues bonds. Investors and banks buy these bonds, giving the government funds to spend.
The central bank can step in and buy
But the central bank can also step in and buy those bonds itself.
sheet increasing. You'll see here,
When the central bank buys bonds, it creates new digital money instantly.
directly into your balance. This is new base
This money didn't exist before. It's created through central bank operations.
entire financial system. The government then utilizes these
The government then uses that money to fund projects and programs.
investing directly back into the community.
For example, a $1.5 billion infrastructure plan injects new money into the economy.
Watch your money
When workers get paid, that money becomes deposits in their bank accounts.
These deposits can be spent, saved,
These deposits can be spent, saved, or used to pay loans.
spending, saving, and repaying debt. As you can see, the balance
In this way, government spending spreads money throughout the entire economy.
stimulating growth.
The central bank also controls how easy it is to borrow money. By raising or lowering interest rates, it changes how much people and businesses borrow.
As you can see, the interest rates are
Lower rates make loans cheaper, encouraging spending.
very accessible. Higher rates significantly
Higher rates slow borrowing, cooling the economy.
cool down the economy and stabilize the market.
Through just these tools, the central bank shapes the flow of money nationwide.
Notice the distinction
But here's something surprising. Central bank money is different from bank-created money.
we are monitoring.
Central bank money exists in two forms, cash and reserves. Reserves are digital money banks use to settle payments between themselves. You can't touch reserves. They never enter your wallet. But reserves matter because they support the whole lending system. When the central bank creates reserves, banks gain more room to lend safely. This combination of government spending and central bank actions helps shape the entire money supply.
Now let's explore how
all this affects the money in your wallet. When more money enters the economy, prices tend to rise over time. This long-term rise in prices is called inflation.
I'm sorry, the price changed. It's $8.
You see inflation when a $3 coffee turns into an $8 one.
Are you serious?
Inflation reduces your money's buying power. It's not magic. Prices rise when money grows faster than available goods. If salaries don't grow fast enough, people feel life getting more expensive. Interest rates also shape how your money moves. When interest rates rise, borrowing becomes more costly. A monthly home loan payment of $70,000 can rise to $90,000 after an interest rate hike. When rates fall, loans get cheaper and spending increases.
As you can see, our high-yield
Savings accounts are affected too. Interest can rise or fall.
It's one of the best rates available.
This is why interest rates feel like the steering wheel of your financial life.
As you can see, the growth in the housing sector is
Money creation also lifts asset prices such as houses.
Should I consider refinancing now?
as you can see,
A house worth $300,000 can rise to $500,000 in just a few years.
Has gone up.
This helps homeowners but makes life harder for first-time buyers. Even if you never borrow, rising prices still reach you.
breaking financial news as the markets
Every decision by banks and governments eventually touches your wallet.
a significant market surge. The capital injection seems
For example, a large government project injects new money into the economy. That money becomes salaries, then deposits, then spending. When spending increases everywhere, prices rise naturally. Your personal budget now feels tighter than before.
This is why financial awareness
becomes your strongest protection. Knowing how money works helps you avoid unnecessary debt. And it allows you to make smarter choices with your savings and spending. Understanding money gives you control instead of confusion. You don't need to be rich. You just need the right knowledge. Start by tracking your spending and avoiding high-interest debt. Then slowly build savings and invest carefully for the long term.
financial confidence
Because once you understand how money is created, you finally understand how to use it wisely.